Hello traders, this is the weekend edition. My name's Dez, here at Grok Trade. It's the weekend edition, get through Sunday, February 8th, 2015. And here is the latest on the markets. On Friday, the markets did a late day sell-off. We were in bullish territory until the last few hours of the day, and then we sold off. But the bottom line is this: banks in bullish territory. Underlying market support very, very strong with the banks here. So I'm not convinced that the markets are serious on a major sell-off. And let me show you something else here. Here's the S&P 500 daily chart per usual. Big symmetrical triangle. In this triangle on Thursday we broke out. On Friday we broke this area of resistance, but we immediately come back down. So with this, when we break an area of resistance, it should act as support. That's why I'm thinking that we're just going to stay below this 2063 mark. This is at 2063 mark here, 2063 on the S&P 500. Here and maybe this trend line. Big possibility we're just going to move sideways going into the beginning of the week. Now, this line was very important to us, and we talked about this. This line here is huge. It's a horizontal line at 2063. We hit it, resistance. So white candlestick, we hit the resistance, red candlestick, and then we correct. We rally up to this line again with a white candlestick. We hit that level, red candlestick, and we correct. We rally higher, white candlestick up to the resistance line, red candlestick. So great chance here for a correction, for a drop. Again, I think this will be support. Again, I think this is a decent chance to be resistance. If we can get above it, that would be bullish. If we could build a high base next week and then break out, that's going to be very bullish. So that's what we're looking at. If the markets immediately come back down inside this area right here, down below this trend line on Monday or even Tuesday, if that happens, this trend line will disappear. It will not be important to me anymore, and then I will make that line come across here. This will be the predominant trend line coming across, and that will be horizontal. And then this line coming across, again horizontal. We will be in a defined trading range. A sideways trend is called, technically it's called a trading range. A trading range is a sideways range where you have a high area 2063, a low area of 1993 down here, 2063 up there, and all the moving averages. Look at the moving averages. They're all right here. And we're just being churned in these moving averages. And I'll tell you, this is a tough environment to trade. A tough environment to trade. And in this environment, and you've heard me say it before, guys, I would say, listen, in a sideways trading market or a trading range or any sort of consolidation, as you get in a big symmetrical triangle, it will chew you up. It will spit you out. I've been trading for 17 years, a long time, actively trading 17 years. I was the first person to ever start doing daily stock trading videos. I was a pioneer. I was the very first doing this. And as you guys know, I think there might be others. I'm not sure. But to date, I think I am the only person who gives predictions based off of technical analysis on a regular basis, who is still active, who is still doing this. A lot of people have washed out. That's kind of the name of the game. Either you can trade or you can't. Either you know how to do it or you don't. And what I have found in a sideways trading market is the amateur beginner traders, those individuals, namely that have not been formally educated, just have the worst time in here. In an uptrend, we get a lot of emails singing our praise. I mean, people blow sunshine our direction, and we love it. We bask in good reports. We love it, love it, love it. In a downtrend, we love it when people send us emails and saying, thank you, man, for helping us dodge the bullet on this one. We saved a ton of money. And you guys who send us emails, you're smiling right now. So I'm just letting you all know we love them. And most of you guys got replies back from us. So thank you, thank you, thank you. Now, let me tell you a time that we do not get rave reviews and where we get something less than stellar responses. And I received 2 within a week. And that is it's not a norm. And I responded in great length to both of them. I'm not going to tell you their names. And they come from a little different backgrounds. But I responded in great detail, and I didn't know I was going this direction, and I'm known to do rants from time to time, and this isn't a rant towards people by any stretch of the imagination. I'm going to be sharing with you, and if you read anything into what I'm saying here, and I want you to know that I'm passionate about 2 things. One, my students and our users and followers. I want you guys to do better than all the other traders out there. I want you to develop faster than all the other traders out there. I want you to make more money than all the other traders out there. That's a passion that I have. Another passion I have is that you don't get hurt in the markets. I do not want you to get hurt in the markets. I do not want to set you up to fail. If anything, I'm saying do not trade. Get out of this market. It is dangerous, dangerous, dangerous. You will lose a lot trading the markets. However, if you take the right steps, you go the right directions, do the right things, then it's just like flying a plane. Then do it, and you can have the best time of your life. And I'll tell you, trading is life-changing. It is that. But you need to make a decision if you're going to be a good trader and do what it takes, pay your dues, go through the gauntlet to become that trader, or just set it aside, paper trade, find some other hobby that's not going to be so expensive for you. But the emails came in, and it had to do with my warnings that I give. And I get that. I call out a warning, say warning, big time warning, markets could be setting up to crash, and we broke support, be careful, be careful, be careful. Things could get slippery here. It's a crack in the ice. You guys, you hear those terms all the time during these warnings, and I give them. And I give them for good reason. It's because I lived through the technology bust. When that bubble popped on technology in right at 2000, I had to navigate those waters. I had to live through that mess. And I lived I lived through it. I lived another day. I can tell you that story now. When 2007, the end of 2007, I'm well known to be the guy who called out the market correction. While the markets were still going higher, I saw the thunder in the distance, the crack in the ice. It was there. I called it. I said, big time thunder in the distance. Look for a big correction. I'm not liking what I'm seeing. All was seen in the charts. 2008, we had the biggest correction in our lifetime. Huge correction in the markets. The financial crash happened. And got a lot of publicity on, how did you know? It's funny how you just watch trend lines and you know technical analysis, and you'll see when things get weak. With the right trained eye, it's an amazing thing. Now, I am pretty transparent. I share with you these things. Let me give you an example here. We go, you remember back here in August, in September, we had this double top. We come over here, double top. And I said, warning, warning, warning. And it drop. And then we get this V bottom. Now, first thing, because this point was brought up, we should know to identify V bottoms. Maybe some of you are better than me. In my 17 years as a active trader, surviving multiple market crashes, and now instructing myself over 850 students, all of us combined, well over 2,000 on a mentorship level, meaning we mentored that many people. There's no way that I know of to identify a V bottom trend reversal pattern. Because once it goes up, it breaks the 25% Fibonacci, 50% Fibonacci, 75% Fibonacci, then it's 100% Fibonacci here, and then it's overextended, but it just keeps going. No one can tell you that. No one knows. No one knows that it's going to keep going higher, but in this case it did. In this case, it just kept going higher. This is where you have strategies where you go long, you stay with your longs based off of certain stop loss management techniques that we teach in mentoring. We teach in the 201 courses that you can immediately, so with the longs that we did put on here, we remained in them. Went higher, higher, higher. Then we go into this rising wedge type formation. I said, warning, warning, warning. We start to break down. Right here, you see this? We break down, but it pops right back up. So that warning that I gave you was it didn't really come to fruition. Then we popped back up. We got up there. I said, warning, warning, warning. And this one really kind of popped down quite a bit. Then it really dropped. Then all of a sudden we got a nice pop. But check this out. Another 100% Fibonacci retracement. Another V bottom, if you will. Just a huge swing. Again, you don't know that's what's going to happen. Anytime you get these V bottoms like this, you go into what's called a trading range. It's very typical for that to happen. We come up here, hit a trend line. Guess what? I'm going to give you a warning, 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 warning. We come up, warning, warning, warning. There it is. We drop. Then we pop up, okay? We do this, we drop. Now I'm saying big time warning. Why am I saying that? Shoulder, head, and shoulder. You have it right there. Big neckline right here. Let me draw this. I don't have to draw it. Big neckline right there. We broke the neckline. Uh-oh. Warning, warning, warning. The market could fall out of bed. Everybody worth their salt in the markets, technically speaking, when it comes to technical analysis, was saying big time warning. We were all saying this. And all of a sudden, we start to bounce here. We thought it'd be a short-term bounce. No, we get a big bounce here. Uh-oh. Another 100%. Look at this. 100% retracement. We drop and 100% meet right back in that spot. And then we drop. So it gives me my 2 points. There's my 2 points. Now we're in a defined symmetrical triangle. We go down, down. Now at this point, if you remember, we actually broke this point. The trend line was there. So this candlestick broke a trend line. Warning, warning, warning. This market could get hairy. And then we started to drop, but people bought back into it. So what do we do during these times? More savvy people are looking to buy down here at these opportunities. Once you pop, there's conviction to it. You stay long until you get stopped out with trailing stops, with more advanced type stop loss positions. Here we pop up. What should happen? Resistance, resistance. What should happen right here? Should stall. It does. Here, and then we pop through, and I said resistance, resistance, watch for resistance. It could stall right here. We popped up and we stalled. That's where we're at right now. But every time I call a warning, the reason I'm going through this, people are just selling automatically. They're taking that as a sell signal. Never once have I told you, you need to start selling stocks or your ETFs or your futures or whatever it is you're trading out there. Not once do I say that. What I do say is warning, warning, warning. I gave an example to one of these followers who sent me an email, and I said it's kind of like this. I live in the Midwest, and when it freezes in the winter, you can walk on the creeks and ponds and stuff here. Not overly safe, but I used to do that as a kid. And we would walk back and forth from our school to home walking a frozen creek. Well, we got very good at knowing what cracking ice sounded like, because once you fall into a cold creek, it's one, dangerous, two, you never want it to happen again. It's a miserable hour after that trying to get home, get dried off. It's horrible. So when we're walking on ice and one of us hears, "Ooh, cracking ice," we say it. We warn to all of every one of us were warned. And what we would do then is we would immediately stop jumping around, having a good time, sliding on the ice. We would walk gingerly, very slow. We would walk softer, slower, and we would spread out to dissipate our weight. So we were very meticulous on how we handled our movement down the ice. And the same holds true here. Didn't mean that we necessarily stopped walking on the ice. Now, sometimes, especially if our foot fell through or something, we'd just walk the bank. We'd get off the ice. It was too thin for us. Certainly time for that. Then if it was just cracked ice, but it wasn't so bad and only cracked when we jumped a little, we would stay on that. But I'm telling you, we were very cautious on how we treaded down that path. Same thing goes in the markets. When I call out a warning, that's a cracked ice. I'm hearing cracked ice. We could drop. I'm telling you, I've been here before. It's kind of like it's negative reinforcement. Anytime you hear cracked ice and then the market bleeds out and you're long and you've taken a hit and then you have to make all that loss back up just to get to break even, when you've lived that, you learn to respect broken ice or the cracking sound of ice. And me, because of my passion for you, because I care about you, I call it out. Warning, warning, warning. This is what I'm doing with my own account. Man, how many other people out there says this is what they're doing in their own account? I'm doing that. Right now, what am I doing? Today, when we popped up, we started selling off, and I knew we were going to close underneath this level, this 2063 level. When I was convinced of that, I went ahead and put on a short position, increased my hedge, and unloaded half of my long positions. Half of my positions were sold today, increased my hedge. I am net to the short side, but I think it'll be short-lived. But I am nimble and quick and know how to navigate these waters. Whatever the markets throw at me, I know how to navigate that. And that's what I teach our students. That's what Mark teaches our students. That's what we teach our students, how to navigate these type of waters, especially a trading range. So the problems with amateur traders, what happens is they're buying when they should be a bear. They're selling when they should be a bull. You're always getting in at the exact wrong moment. Exact wrong time. I mean, ask yourself this. If you just played the opposite trade for the last month, would you be up money or down money? Most of you, if you're just, especially if you're just developing and you haven't had any formalized trading education, you will be the person who says, if only if I took the reverse trade on all my trades in the past year, you would be a gazillionaire. You'd make a ton of money. So one of my guys I got an email from runs a brokerage firm. He's trading large sums of money for a brokerage house. We got a lot of brokers that come in, and he's doing that trading mutual funds. Unfortunately, there's only one trade a day on mutual funds, and so it's hard to be nimble, and trading on a swing type of account makes it very hard. You almost have to do a weekly chart to trade that way. But this is somebody that has not gone through the 301 mentorship, step 3. I don't even know if he's been through the step 2, the 201s. And then just to watch a free 5-minute video to get their trading cues without knowing advanced exit strategies, how to preserve capital, not knowing how and where to enter, and not knowing how to measure a risk to reward measurement, not how to do a risk parameter on an entire portfolio. All of this matters. It's about being either amateur or being professional in your career. I want to go from hobby to career. I want you to do something special. Let me tell you what we've done. I had a mentor myself. When I had my mentor, I went through and I thought, this is the best way of learning. Man, I wish I didn't spend the money on the seminars and the books. I just put me with somebody that trades live in the markets and is doing it. And because I learned that style so well, I thought this is the only way to teach. This is why we have a mentorship program. But most of you guys aren't even ready for a mentorship program because you don't have the basic language down. We have to be able to talk the same language. I mean, at least take the 101s, at least take the 201s, and then from there take the 301 mentorship. It's lifetime mentoring with us. And anyway, this has turned into almost a commercial. It's more of a rant, but they coincide with each other. We have what you need in the market. So this very long video rant, I hope is well taken, and I hope you learned something from it. Thanks so much. We'll catch you guys later.